Good afternoon, everyone. This is Stuart. Hope you're having a great Monday. On this week's update, we'll discuss trade progress, price controls, a quick health check for the S&P 500, and Apple, Alphabet, and antitrust. The Trump administration has been making trade progress. Over the last week, we've announced trade frameworks with the UK and China that would see tariff levels drop down to 10%. We think 10% is more or less where we'll see tariff levels across the board with all of our trade partners. This is much less severe than what had been feared just a month ago, and understandably, markets are rallying on the renewed trade optimism. The Trump administration announced price controls targeting the pharma industry over the weekend. The idea being that US patients should not be paying higher drug prices than patients in foreign markets for the same drugs. Now, while this is intuitively understandable and perhaps even a sympathetic argument, it's on shaky legal footing. The Trump administration tried doing the same thing in its first term and was blocked by courts. And we also think it's economically risky to announce price controls on any industry. It might be pharma today, but under similar reasoning, it could be any other industry tomorrow. As for pharma companies, we think the risks are navigable. As part of any trade agreement with foreign developed markets, we do think that higher pricing for US drugs will be part of the negotiation. The S&P 500 continues to rally. The drawdown from highs is now only at about 5%. We were closer to a 20% sell-off at the lows last month, and the index is at a higher level than it was prior to the April 2nd Liberation Day tariff announcements. On quarter one earnings calls, companies were guiding a bit lower. This reflected probably a more difficult tariff environment than the one in which we're at a 10% level. So we'll need to see over the coming quarter or two if companies are feeling better about the outlook. Investors are certainly feeling better about the outlook. US markets rallying another 3% today, and foreign markets are doing well also. Here's a sensitivity matrix for the S&P 500. It just shows the performance that the index would have to get to various levels. At 22 times forward earnings, that is a rich multiple relative to history. So any additional upside will likely need to come from earnings coming in at a higher than expected consensus of 262. There is downside risk if earnings growth does not materialize or if the multiple contracts. But we're in a fundamentally better place today if tariffs will only be 10% than we were just a few weeks ago. There was big news last week coming out of a court case. Apple's Eddie Q, who's an exec at the company, said that for the first time, Safari was starting to see declining search on the app. Now, the implication is that must mean Alphabet's Google is starting to see an erosion in its market share because Google is the default search engine on Safari. That sent Alphabet shares down 7%. A couple things could be happening. It is possible that Google is, in fact, starting to see an erosion of its market share in the face of competition from ChatGPT, Perplexity, Claude, and other AI services. We also think it's possible that Apple was being strategic here. If they're implying that Google's grip on the search market is starting to erode, that also implies that Google no longer has a search monopoly. If they don't have a search monopoly, it's not an anti-competitive problem for Alphabet to be paying Apple $25 billion plus a year to be the default search engine. We'll need to watch results going forward from Google to see what the search trends are. Alphabet did come out with a PR statement last week saying that they are not, in fact, seeing market share decline and that search is being used at a higher rate. That also comports with Google's first quarter earnings, in which they said that the important cost per click metric was growing and that search results were growing as well. Given investors' concerns about Google's position in the search market, the stock is not trading at an expensive valuation. Alphabet trades at about 15.5 times forward earnings. That's the lowest forward PE ratio it's had in the last 10 years. That despite revenue coming in at 12% year-over-year growth. Now, there are many levers that Alphabet has to pull on. YouTube is a gargantuan in the media and advertising market. Its driverless car unit, Waymo, is gaining market share at a rapid clip. Its cloud business finally inflected to profitability. And Google search itself is still growing. Just the concern is, what's it look like in a world with more competition from AI? We think many of those concerns are factored into the valuation. The stock is at an interesting place. The hurdle rate for it to perform well here is not very high. So if you want to talk about Alphabet or any other opportunities or your portfolio more generally, please feel free to reach out. Thank you very much and have a great start to your week.